The top 10 buy and hold forever dividend stocks. We're going to take a look at the historical performance of each one of these companies. We're going to take a look at their dividend safety, looking at some of their strong financial metrics, and as always we will run them through our valuation model, getting to the intrinsic value as well as the acceptable buy price given our investor margin of safety, and as always we'll take a look and see what Wall Street are expecting for each one of these stocks over the next 12 months. So let's jump into the first dividend stock we have. Microsoft Corporation. Now they are the largest vendor of computer software in the world, as well as the leading provider of cloud computing services, video games, computer and gaming hardware, search and other online services, and have recently overtaken Apple in terms of market cap. Now over the last year, they are up around 63%. We can now see them trading right at their 52-week high. They do offer a year yield of 77% and around 34.66345. Inbound in 2024 they maintained the dividend. During the last recession they had above average growth net of 8.8%. Versus the S&P's -12, and they also outperformed the S&P, although marginally, with a negative 48% return versus the S&P's 55 dividend growth. Lots to love here. Consistent increases, 10% in September last year, 10% on average over the last 5 years, 19% on average over the last 20 years, well above that minimum 4% we advocate on the channel to keep up in line with inflation, and they have been increasing those dividends for the last 13 years in terms of dividend yield theory. Then those that are new to the channel, it states the company is undervalued when the current yield sits above the 5-year average. So we have our first sign here of overvaluation, but bear in mind, we're not looking at any of these models in isolation, and we draw our conclusions towards the end of the episode. Forward P, however, 34.6, it is sitting again above the 5-year average of 29.9. So that is another sign of overvaluation, and we can see Microsoft P is sitting significantly higher than the information technology at 24.6. Now for those that are new, it is important to note we do ignore the earnings payout ratio. It is susceptible to manipulation by management through accounting. We tend to focus on the free cash flow payout. The reason for this is essentially it is a more truer picture. Below 60% is our preference for the majority of companies, and for me personally, if it is below 60%, it gives me faith that management are able to offer those double-digit increases we love to see, and we've come to love with Microsoft. 2023 34%, very positive to see. 2024 expected pretty much in line, so I would expect us to have a nice double-digit increase in 2024 for Microsoft. Free cash flow per share 326 in 2014, $8 in 2023. It is growing very positively. Slight inconsistencies, as we can see it has fallen some years, but over the broader term it is moving in the right direction. 2024 again expected to go even higher, so is positive to note for investors as well as potential investors. Typically on the top line we like steady moderate growth of 3 to 7%, and we can see for Microsoft for the majority of the years they have Had double-digit increases to the top-line revenue 2023 7%. Is still strong and at the upper end of the minimum we look for numerically then for those that like to see the numbers. 87 billion in sales in 2014, 212 in 2023. So some very strong growth, and we can see they have also done share buybacks, which we love to see, as investors essentially returning excess cash to investor pockets. 8.4 billion in 2014 to 7.47 billion in 20,123 ROIC. Then this is one of my 7 golden dividend metrics. 10% or more is my personal target. Gives me faith that management are able to effectively allocate their capital. 2023 at 31% is very strong, and over the last few years they have had some very high ROIC numbers. Gives me faith when I am considering management in the investing decision. Operating margin very high, well above the minimum 12%, and the same on the free cash flow margin. 42% in 2023. 28% for the free cash flow margin. Microsoft is a free cash flow machine. Now the final metric that we do tend to look at is the net debt EBITDA, standing for earnings before interest, tax, depreciation, amortization. This shows us two things: one, the balance sheet strength, and secondly, the dividend safety. And these are the number of years it would take the company to pay off all of their debt net of cash on hand. Essentially showing that Microsoft have an incredibly safe balance sheet, and that dividend is going nowhere. So for Microsoft, they have a very strong metric here. Now we can jump into the value for Microsoft company, and typically on the channel we run through each one of these companies through our valuation model. We do run through every single model that you see: Graham's valuation multiples, the dividend discount, the discount in cash flow. Today's episode we're going to jump straight into the valuation, where essentially for today's Microsoft analysis, the intrinsic value is the average of these three models, coming to $386. Now the current price, as we can see, isn't too far off, so we do believe Microsoft is trading at around its intrinsic value. Typically on the channel, what we like to do is start off with a margin of safety of around 10%, and we use this to determine the buy price if a company has a wide moat, strong financial metrics, and good forward-looking data, and then we change this percentage depending on, as an investor, what percentage we are comfortable with. Different investors will have different amounts, but for today's episode of Microsoft we can see it is pretty much trading at a 0% margin of safety, so it is around the intrinsic value in terms of Wall Street and what they believe. Well, they still see the share price to go up to $420 over the next 12 months, so they see upside of around